What's going on, guys? In this video, I'm going to be talking about the 7 rules for picking high quality dividend stocks. Now, there's a lot more than just 7, but over the years, this is at least what I have learned to be very important when you're picking certain stocks. And it doesn't just have to be for dividend stocks. It could be for regular stocks as well. This isn't financial advice. This video is for education and entertainment purposes only. But let's dive in. So first, what is a dividend stock? You could jump over to many different programs. One that I like to use is stockanalysis.com. There's TradingView, and then there's Seeking Alpha. Those are pretty much like the 3 big ones I like to use. But let's type in a dividend stock. Coca-Cola. We all know the company. We've all probably had its drink before. Coke is a dividend stock. So what does that mean? If you go over to dividends, right over here, and you see annual dividend, $1.76. You were getting paid $1.76 just to hold 1 share of Coca-Cola. How much is the share of Coca-Cola currently? $63.53. So if you were to have 10 shares of Coca-Cola, take this 176 and multiply that by 10. You would get paid each year $10.76. And that fluctuates. It goes up and down depending on a whole bunch of different factors. In the long term, you would hope that it goes up, which Coke has done over time. You could see here's its cash payout every single month. Here's a nice chart. Over time, it has been going up. So pretty self-explanatory, pretty easy, pretty much just the profit of a company and then paying its shareholders or its owners of the business, because that's what you are when you own a stock. Now, we're done with the explanation. We all probably know what dividends are, especially if you're looking at this video. But the very first thing is dividend yield. Dividend yield has got to be one of the most important things to look at. That really should be how you're picking certain dividend stocks if that's how you want to generate money. So I have a nice little description here. This is the annual dividend payout, which I pretty much just already went over by the stock price. A high dividend yield may seem attractive, but it could also be a red flag. That is super important that people need to realize. So if we jump back over, here's our dividend payout, which is that $1.76. And then here is its dividend yield. That's what we're talking about right now. 2%. May seem super small, but this is a pretty good percentage. You really should be looking for anything in between maybe 2% and 4 or 5%. Once you get higher than 4 or 5%, it is not sustainable. I remember a good example, and let's look it up. The Boeing company currently not paying dividends. You see that how it says NA? BA has not paid any dividends in the past year, and the next dividend date is unknown. But look, it used to be a dividend paying company. You could see before COVID, back in February of 2020, it paid out its last dividend, which was $2.05. What happened to BA, Boeing? Let's look. If we go to overview, let's go to the past 5 years. It had this massive drop during 2020. So right here, February, it had its last payout when the stock was over $300, and then it plummeted all the way down to $95. When you have that huge drop, the yield is going to skyrocket, and then that's called a dividend yield trap. So the yield was like 10% or something crazy, and everyone thought, oh, this is great. I'm going to get 10% dividend yield. Let me buy into Boeing, and then they suspended their payouts, and no one ever got paid since February 2020. So just because the dividend yield is super high, sometimes it is too good to be true. So you want to look for those sweet spots. How about something like, so if we look at Target, everyone shops at Target, and 2.81%, that's another stock in the sweet spot. It has been constantly paying out dividends even after the COVID crash. Here was the COVID crash, and then it has continued to pay out its dividends and steadily gone up in price. So that would have been a good dividend stock to buy. One that kind of raises suspicion is something like, AT&T, 7.4%. Sounds a little too good to be true. So this kind of has a little bit of a red flag to me. I don't know exactly what's going to happen with this, but I don't think this level is sustainable. But let's move on from dividend yield. The next is the payout ratio. And this ties in really well with the dividend yield. This is the percentage of earnings that a company pays out in dividends. A low payout ratio indicates that the company has room to increase its dividends in the future. So let's jump back over to stock analysis. You could see, even though I said AT&T is a red flag with its dividend yield being so high, its payout ratio isn't that bad. It's 57%. Dividend growth, on the other hand, is not looking good. So this may not be something you'd want to look at. So let's jump back over to Target, because Target not only has a good dividend yield, good payout ratio, good dividend growth, but I am getting ahead of myself with the dividend growth. But I just want to show you better examples. So a payout ratio is 65%. Pretend you're a business, you make $100,000 a year and you have investors. Your payout ratio, 100,000, not revenue, but profit. That's what you're walking away with. Revenue is whatever, say 250,000. After you pay your expenses, payroll, all that, you're left with 100 grand. That payout ratio is what you are giving from that money left over. So in that example, you'd be giving $65,000 to all of your investors. So depending on how that's split up, that's how they would get it. So yeah, you would want to see a payout ratio that has room to grow. Target obviously has room to grow. Next year, maybe they could give 66% or 67%. People typically want to find a payout ratio in between, maybe on the low end, 40%, and on the high end, maybe 60 or 70%. Once you get above 70%, there's really not that much room to grow. Sure, there is, but you got to think that money's now cutting in to, say, research and development. If they're giving out 100% of their payout ratio, there's no money left to expand and grow the company. So you kind of want that sweet spot in between maybe 60 or 70%. So then there's enough money left over for them to continue to grow as a company. So next, speaking about growth, we want to talk about EPS growth. That's earnings per share. A company's ability to increase its EPS is an important factor in its ability to sustain and increase its dividends over time. So we jump back to Target. Let's look at its EPS growth. You could look at, there's probably a ratio somewhere here, EPS, earnings per share is that. I'm sure there's some kind of growth here, but I'm not even going to look at that. I'm going to go right to the financials. So if we go to financials, we could look at, say, their net income, and this is 2021 all the way back to 2014. Here's their earnings per share. Oh, okay, here's their earnings per share growth. I found it. So you could see over the years, it looks like it has been getting better and better, and they have continued to grow their earnings per share. So they are making more money, which means they could continue to increase their dividends and they could continue to have money to put back into research and development. So that is another good sign. Next is financial health. We're already in the finances. You got to do some digging around. This could be a whole nother video, learning about how to look at income, balance sheet, and cash flow. But that is an easy thing. Their net income. Are they a profitable company? Are they making money? Yes, you could see Target is making money, and it looks like they continue to increase their profit. What about their revenue? Their revenue is also going up. That's great. Then you can start to dive into the more important stuff, or the less known, like what does their free cash flow look like? So here's their free cash flow. Do they have money on hand, or are they just burning through it all? You can see this year, it was a pretty expensive year for them. They lost a decent amount of free cash flow, probably because there's no more stimulus money going around. There could be different reasons why. And then another big one that I like to look at, if we go over to ratios, what's their debt look like? Their debt to equity, little high, but not terrible. People like Warren Buffett like to look for debt to equity ratios below 1, or maybe even closer to like 50%, so 0.5. But that's another thing to look at. Debt to equity, are they carrying too much debt? Again, that could be a whole nother video getting into debt to equity, but that is something you need to look at when you're considering buying dividend stocks. What does their financial health look like? Then next, we go into industry outlook. So they could look like they have good financial health, but if it's something like Xerox and it's 2005, the industry outlook may not be too good, because you may be thinking, well, hold on, we don't need Xerox machines anymore. There's this thing called the computer and the internet, and people could just print it out or send emails. So the industry outlook is looking pretty bleak. You want to keep that in mind as well. Is it an industry that is booming? Is it a staple that's not going to go anywhere? So again, I don't want to keep talking up Target. We could look at other companies. How about like Procter & Gamble? That's another big dividend stock. The industry outlook for Procter & Gamble, this is Procter & Gamble. There we go. The industry outlook for Procter & Gamble, I mean, it's in the chemicals and health industry. That's not going anywhere. So, the industry outlook for that You're always going to need it. That's always going to be a staple. Tech industries, what about, say, like, I know this isn't a dividend paying stock, but this is a good example. Netflix, what does the industry look like? It is becoming overcrowded. Everyone has streaming software now. Everyone could stream. You have Disney, you have ABC, you have all these different companies. Paramount are coming up with these streaming programs. So it's really straining on Netflix because there's just a flood of competition now. So the industry outlook might not be that great because now everyone's trying to compete for that. But again, Netflix, it's not a dividend stock, but you guys know what I'm trying to say. So if you're still here, props to you. We got 2 more to go. Management team. So you got to look at the management team. How's the CEO? Are they very volatile? Are they maybe some huge billionaire that buys Twitter, and where's that money coming from? They got to sell their Tesla shares. You got to really look at the management team. So for Target, the management team is not going to be on a chart, but a simple Google search, you could look into the board of directors, you could look into the CEO and all of that, and you could really dive into, okay, what are the executives doing? What kind of history do they have? Almost like your own little research on, is the management team a good fit for the company? Are they looking out for the best of the company? But again, I'm not going to get too far into that because that could be another huge video in itself. And last thing is valuation. Be sure to consider a stock's valuation. Company that looks cheap based on its price to earnings ratio or other valuation metrics may not be a good dividend growth investment if its dividend is not sustainable. So that was like the AT&T example. Its valuation is, just because its dividend's really high at 7% right now, you're losing money in the value. So it doesn't even matter that you're making that 7% because over the past year, you're losing money. You're losing maybe 7%. Well, year to date, you're losing 3%, but that needs to be put into consideration. Just because you're making a high dividend doesn't necessarily mean that you're going to be coming out ahead. You want to look for a company that not only will appreciate over time, but also will raise their dividends. You need to find that best of both worlds example. And one thing that a lot of new investors will do, here's a perfect example. Again, not a dividend stock, but it applies to this. You look at something like Amazon and you'll think, wow, look at that. From COVID all the way to the end of 2021, it's up almost 90%. So people would jump on board thinking, this is a great time to buy. This is at a great value. It is not. You may think, but look, it's been in a channel for almost a year. It's bound to explode. Not necessarily the case, because if we go from this point to today, you're down almost 50%. You invest $10,000 into Amazon, now you're down to $5,000. So value is super important. It goes both ways. Just because the stock keeps going up doesn't mean it will continue to go up. And just because a dividend is really high doesn't mean the stock will be in your favor. So those are other aspects that you need to look into. But those are at least my 7 rules for picking high quality dividend stocks. Guys, if you like this video, make sure to smash that like button. I hope you learned something today. And as always, I will see you in the next one.